Do you run a service business, and have you ever looked at your profit and loss and thought, what the heck am I even looking at? Well, I'm Tim with Cornerstone CPA. I'm the operations partner, and today we're going to go over a profit and loss overview for a service business with some industry standards here. So let's dive right in. First off, what is a profit and loss? Seems pretty straightforward. A few key takeaways here is that is how much the business has been making over a certain period of time. So in this case, we're looking at 1 month here. One important side note is this does not show the exact cash flow of the business as a whole. This just shows the profit and or loss of the operations of the business. The debts are actually handled in a different spot, but this is just for the operations here. There are essentially three sections of a profit and loss. You have the income section at the top here, which then gets all these numbers get added in, and then it gets to this bold number right here. And then you have the COGS section, which we're going to go over this later here. All these get added in to this number right here. And then you are going to be taking your total income. Your total income minus your COGS is going to give us your gross profit margin. That then is going to go through all these other expenses called operating expenses or OPEX, which we're also going to go over as well. And all those are going to equal this number right here. And then you're going to take your gross profit margin up at the top here again, minus it by the total expenses, and that will give you then your net income. I have something turned on here that I like, which is called percent of income inside of QuickBooks for the reports, so that we could see what percentage of the income comes from each individual section here. So, for example, like this is 57% is the gross profit margin of this particular profit and loss right here. So, we're going to be going over some averages, some gross profit margin, net profit margin, things like that. You can look up the averages for your individual industry. We do have a few individual industry videos on the YouTube channel, but if not, you can also look up some with some of these resources right here to be able to actually find out what is an industry average for your industry, because they vary wildly. Service businesses are 70% of US businesses, so it is a huge category. But for most of them, their profit and losses will be somewhat similar. So first off, we're going to do the COGS, or the cost of goods sold. The important key takeaway here is that this is the cost for producing the goods sold by the company. So we're an accounting company. We provide accounting services. So we don't provide like products, but even in our company, we have in our COGS, we have our production team, our bookkeeping team, our tax team is in the COGS category. If you're a roofing company, this would be not only your labor costs, but also your materials, your subs, your travel fees would also be in there. This is essentially with COGS. When you get more work, the cost of the COGS for fulfilling the work should go up in proportion to that work. OPEX, which we'll go into in the next section, in general should not move. Things like rent. Like if you're renting out office space, for the most part, if you increase your amount of production by 10%, your office rent is not going to be going up at all. This lets you know how efficient you are at actually doing the work. So in this particular example here, we have our labor costs, materials, subs, and travel, and a huge ballpark, and this varies wildly for service businesses, which is why it's such a huge range. Usually 20 to 50% is going to be your gross profit margin, or going to be your cost of goods sold is going to be between, in general, 20 to 50%. Again, look up your individual industry. Based on this chart over here, we have this one's currently at 42.71% of the total income is actually going to be the cost of goods sold, and then you can minus that by the 100% here, and that'll give you, the 57 and change down below. That's actually your gross profit, which we'll get into right here, talking about the gross profit margin, which is simply just a ratio of those two other numbers. Because this also helps like for seasonality. If you have some seasonality, yes, your income might drop, but also hopefully your COGS drops somewhat as well, so you can keep a similar gross profit margin. Again, there's a lot of variance with that. But this is simply a percentage representation, which also makes it really useful to compare month to month. And for your gross profit margin, and aiming in the industry, kind of the inverse of the other numbers, but 30 to 60% is what we're looking for here. So in our example, again, our total income, 100%, and then the total cost of goods sold 42.71, and then the gross profit margin in this scenario would be 57%. Here's some simple math to figure that out. Just to get your gross profit, and then some simple division for your gross profit margin, which this also really helps when you're looking at numbers very quickly. So, and if you have a great gross profit margin, awesome. Like, you have more room to push potentially on marketing and get more things sold, or you're really good at selling, which is awesome. Average, again, between 30 and 60%. Again, huge range, but we're talking all service businesses. And if you are below this, this is where it really comes in. This last year, I've seen this quite a bit, where there has been some issues with efficiency in the team, in the jobs, where, like, cost of goods or the materials supplies, especially since COVID, the supplier costs have gone up a lot, but some of our business owners have not been raising their prices to keep up with those supplier costs, and so it's compressing their gross profit margin and making their business overall a lot less profitable. So, next section of our profit and loss, it's called the OpEx, or operating expenses, and some big distinctions here. So these aren't directly tied to the work. Operating expenses cover things that involve running the business overall. So such things like having your office and your admin. Your admin person, if you don't have enough jobs, you'll end up letting them go over time. But in general, their pay rate's going to be relatively stable as the work fluctuates. And marketing and advertising is also put in here. Your rent especially is put in here. Insurance, and then professional fees and technology costs. So these would be your accountants, your lawyers, things like that. And then technology costs, this would be your software subscriptions. Most software subscriptions that are out there, you pay for a certain amount on a monthly basis, and it does not fluctuate with actually the job that you do. So that's why this is put in here, and this lets you know how efficient your office essentially is running versus how efficiently you are doing the actual work. So an industry benchmark for service businesses is around 20 to 30% of your revenue will go to your operating expenses. So if we look at this one here, again, all the very similar expenses that we had just talked about. Also your meals is in here if they're not actually like work or travel meals, and your actual there's mileage in here can be as well if it's not travel related, things like that. And in this scenario, the total operating expenses is $22,000, which is about 36.5%, which again, for the industry average, is a really, really wide ballpark. This is slightly over. So maybe there's something in here that you might be able to trim down. Maybe there's something here you might be able to cut and adjust from there. But again, you should look up your individual industry to see what your operating expenses benchmarks could be. Because, for example, plumbers have a much higher operating expense percentage than roofers. Plumbers spend a lot more money, typically, in advertising than roofers do, at least from the industry average that I looked at. So that is something that you would have to consider and look at for your individual industry, but this is how you read it as a whole. So, and then your net profit margin, which is simply just like gross profit margin, it is going to be the ratio of basically every dollar that you make down to the net profit of the business. And wide industry averages are 10 to 20%. I've seen them up to 25% for some industries. I've seen them down to 7% for some industries. But the net profit margin is this number down here, which for this company is 20.76%. And this actually shows from the entire business how we're looking at the net income. If you're only going to look at one number, I would look at your net income profit percentage. That's what I would look at if you're just going to look at one number. Primarily, when I look at a profit and loss, I look at three numbers. That's going to be my total income, because I like to know that, my gross profit, and then my net income. So 3 to 4 numbers. Or if you want to look at your total expenses, but you're going to be looking at those ratios to see where they're at. And the important thing is going to be over time. Do those change over time? You know, just looking at them 1 month is some information, but looking at it month to month to month and you knowing how you're doing with those is really going to let you know if you need to make some changes in your actual business. Here's again the formulas, exact same as gross profit margin, but the formulas for how we figure out actually your net profit margin. And then some suggestions, obviously, if you're doing really well with this, great, grow, push on the gas, rock and roll. If you're in the middle part, hey, you're doing well. And then if you're below, the problem with looking at only net profit margins instead of gross profit margins and net profit margins is that you don't know if you have low net profit margins, if it's your operating expenses that are high or your COGS that are too high. So that's where you have to dive in to see, is the problem in the field, or is the problem in producing the work, or is the problem actually in the office itself? So some simple decisions that can be made from your profit and loss. If you have your work, which I would recommend, if you have like, commercial, residential, if you have your work divided up by different service that you provide, you do that typically by class inside of QuickBooks. Then you're going to identify which services are most profitable. This is huge, especially for people who do government work and then do residential work. It's like the government work could pay a lot more, but it's also a lot more expensive. So how do you know if you're actually making a profit or if you're bidding that accurately? And then this lets you know, and a lot of our clients are at this place now, if they need to adjust pricing for their services because they aren't covering the costs, and especially related to the COGS right there. So it also lets you know if you have high operating expenses and then you can cut back on unnecessary spending in the office. And then it just lets you know how your business is doing, like on a profit and loss, on do you have more energy, more dollars you can put in other places of your business? And are you being as efficient as you should be, or as other people are in your industry? So some good round numbers here. And again, these numbers, depends on your business, are going to be very different. But here's kind of the ratios we talked about. So seasonality is also going to definitely play a big piece in this, but you can also look back to last year's season and then look at those ratios, maybe not the numbers themselves, but the ratios to give you an idea of what you should expect in the coming year and in the coming season. So that's where it really helps with forecasting and stuff as well. So if I'm going to look at this profit and loss here in just a minute or two, what would I be looking at? Okay, I would look in and I would say, okay, my total income, $60,000. Let's say that's good for me. I'll look at my gross profit margin, 57%. Let's say that I'm aiming for 60. So, okay, so hey, maybe we're a little bit low on something. Maybe one of these sort of fees, and 60 would be nice and high. Maybe one of these is higher than I would like. And then looking down at my total expenses and net income. Okay, office expenses are a lot higher than I was expecting. I aim for 30%. I'm at 36. What's going on here? Why did we spend $3,400 in office supplies? By the way, also are my office salaries too high? Like, do I need to potentially look at, are we being as efficient as we could be with this? And then going down to 20%, let's say that is slightly below range. Also lets me know, okay, this month was a little bit tougher than we would have liked on this. But now I know, hey, okay, gross profit margins, close to the ballpark, pretty close. Hey, what's going on with the total expenses? Why did we spend $3,000 last month on office supplies? Was it a one-time thing that now is going to be, we bought a new computer, which actually that should be on the balance sheet, but we won't get into that. We bought a lot of office supplies, like we stocked up on all of our office supplies for the year, and now we're going to go the rest of the year. Is that the scenario? Again, you would know in your business, but at least this lets you know where to look at for where potential issues can be, and so we can see those slight fluctuations that over time, before you see it in your bank account and you just have way less money in your bank account, you're able to see some things here before it gets to that stage, which is going to be really helpful in your business for sure. So thank you very much for your time. I'm Tim Kraus with Cornerstone CPA. I'm the operations partner. If you'd like to check us out more, there's a link in the description. And also we have more YouTube videos for you to watch. Thank you very much for your time. Have a good day. Bye.